It just seems like we're in a situation here where there's a lot of physical demand for gold. Central banks buying all around the world. Now we're kind of transitioning to a point in time where we could see easing of rates, a weaker dollar, which is positive for gold.
This is Jay Martin.
Darren, Ryan, it's great to have you guys in studio today.
Great to be here. Appreciate the time.
No, pleasure's all mine. Yeah, Darren, you and I had the chance to chat like about a year ago on the show, and then Ryan joined me on stage at my conference in Vancouver. And it was days after the Marathon acquisition. So it was a pretty exciting time to have you on stage and jam on that. And obviously a lot's happened since then. So I want to touch on the Calibre story, obviously, and I think it's a pretty exciting moment in the company's history. We'll get into why. Some huge catalysts in the pipeline that are very real and near term. For anybody who's brand new, Calibre became a producer in 2019 with the acquisition of B2's Nicaraguan assets, those assets, right? Which is sort of structured almost more like a partnership in that they retained like a 35% ownership in the company at that time. And then the acquisition of Fiore Gold in Nevada, adding production ounces. This more recent acquisition of Marathon, I don't want to say it was a pivot, but it was a different deal, right? Because you weren't buying production, you're buying near-term production. It's a different beast. How's that for a summary of who Calibre is? And
I think it's a great summary. If you think about, where we started as an explorer, prospect developer, and then in the summer of 2019, decided that we wanted to develop a quality mid-tier producer, and that was purchasing or partnering with B2 Gold and the assets in Nicaragua, growing that production, which allowed for the purchase of the Nevada assets, and then most recently with the acquisition of Marathon Gold for the Valentine project in Newfoundland, right?
Yeah.
A great asset in a fantastic jurisdiction, and a little different than our path had been on when you talk about production growth. It was an earlier stage project. And the attractiveness was, it's a great asset. And the company that had it, it was, got itself into a situation where it had a need, and that need was cash. And because of our demonstrated ability over the last 4 years to deliver into expectations and generate cash, it allowed us to come in and satisfy that need. So it's kind of more of a quintessential old school deal, if you think about it, right? There was a need, there's a solution, 1 + 1 = 3 or 4 or 5. So that's why we transacted on it, right? Good asset, there was a need, we could come in, acquire the asset, and satisfy a need from the Marathon shareholder perspective as well. Marathon unfortunately was trading at a 4 or 5 year low when we made the offer. So, the shareholders, were concerned about where things were at. Coming in and making this transaction, has allowed them to get back to a very positive position from a share price perspective as well. So,
and I think importantly in that one too is that we weren't just, it wasn't an acquisition that made sense from a diversification perspective. It was also, this is going to be in production in the next 12 months.
Right.
It had gone through permitting, had gone through resource delineation, reserves, feasibility study. So it was very advanced, but wasn't in production yet. So we could put our hands on the wheel and make sure that, we're going to make sure that this gets delivered. And at the right time, the right price.
It is a good segue, Ryan, because you think about it as production with growth or with organic growth opportunity, it kind of is in a kind of asinine sort of way, because it's got zero production going to significant production within 12 to 18 months. If you acquire a producing asset and you want to grow that asset base, there is a time lag to do that as well.
100%.
So we're just going from 0 to 100 in 18 months as opposed to going from 50 to 100. Right? And where the asset was at from a development perspective, it was in a good situation. We've progressed it since closing the transaction in January. We're now at 75% complete, 98% engineered. We're less than a year away from commercial production. Right? So, again, it's pretty rapid growth. It's not an early stage project that has to go through permitting, and then it has to go through financing, then it has to go through development. We're in those final stages.
Yeah.
And that was the opportunistic part, right? From us being able to come in and do the deal with Marathon.
And a unique find. I mean, exactly for the reasons you just said there. One of the best things about Calibre is you guys haven't seen a hot gold market yet, right? So, the acquisitions and the ounce growth, right, has yet to realize a hot gold market. We had a glimpse maybe during the government's liquidity party in 2020, but it was short-lived, right? It wasn't extended. And backing up on that concept, actually, because I know you guys just got back from a few weeks traveling through Asia, telling the story, meeting with investors. My audience is primarily American and Canadian, and we can get a bit of inside our own echo chamber when it comes to gold sentiment. But talk to me about how those conversations went through Hong Kong, through Taipei. What's sentiment like, and what are investors? How are they responding to a story like Calibre right now?
Yeah, we first started in Australia, and it was a bit of a unique situation because, honestly, first of all, what happens is an Australian fund kind of puts their back up right away. It's like, why is a TSX kind of producer coming to introduce their story to us? Because, the ASX is well known for Australian gold producers. It's a top jurisdiction. It's a top producer of the metal. Mm-hmm. So there was a little bit of that out of the gate, but it worked well because obviously with Darren's background, his history, the Aussie in the room, it helped bridge the gap a little bit. But as we got into the story with the Australians, it's like, they're used to investing in West Africa and Australia. And what they've been seeing is more of the same assets, but rehashed in a different way. So a new name, it's a new kind of a gold price bull market. So, let's rehash a story. Whereas we were there purely as a value play. Look at what we're doing, look what we've done, and look at the valuation versus some ASX listed producers. So, and it was the first time for many of them to see who are these guys, what are they doing? And a number of accounts kind of stepped back and said, well, this is refreshing, this is interesting, this is new, particularly when you look at Valentine in Canada, that's a greenfield site. It's brand new.
This is the Marathon project, Valentine.
Correct. Yeah, that's right. So I think it was a great, in Australia, it was an introduction to a TSX listed company where they can invest in global equities. And there's big capital there, right? Superannuation funds, a huge amount. I think we did the numbers, we were talking about this. Net 150 billion annually into superannuation, so looking for new products to invest in.
Interesting.
And they're not just focused domestically, they're looking internationally as well.
Okay.
And leading back into Jay's question about, market and sentiment.
Yeah.
Right, is that the Australian market is a little more in tune to the gold equity and the value that can come from it.
Okay.
Right. And, we've seen, some good gold price movement in the last little while, but we have a disconnect between the equities and the commodity.
Right.
So people in that part of the world recognize the value in gold as a store of wealth, and some of the macroeconomic issues that exist today that point to a continued improvement in the gold price. And importantly, because of the resource base, they understand the torque that comes from the equity as well, and we've seen a bit of a lag in the space. So we turn up, there is no ask. We're not looking to raise money. We're funded on all of our development needs. We don't have a requirement. So they're going, well, what are you guys here for? Well, we're here to meet some shareholders that have been part of the story and have participated in the 60 cent to $2 plus growth that they've seen over the last couple of years, right? So to meet them in their home soil and say thanks very much for their support, participation, and also let people know what we are and the opportunity that can present. And then let people, they can make their decision. So if they see that attractiveness to participating in the equity space, it's a good opportunity.
Yeah.
So it was I think it was a little bit confusing for them.
Interesting.
Right? Because, most TSX listed companies would turn up and there'd be a request. There's an ask. Well, what's the ask here?
Yeah. Yeah.
And it's like, well, there isn't an ask. Okay. So, it was an interesting space in Australia. And I think there's an interest in the product as a consequence. And then the Asian tour, so we spent some time in Hong Kong and Singapore. They're very strong on gold, right? They have a perspective on the things that drive gold, like inflation rates, US economy, strength of the US dollar.
Do you think just a better grasp of those drivers, is that the main change in sentiment and what drives sentiment?
Well, I think the ability is the US is such a large market and it influences a lot of the rest of the world, there's no doubt.
Of course.
But when you're inside that market, all you see is that market.
Yeah, 100%. 100%.
Right? So it's a little bit like, I'll use the analogy of it's like being a goldfish inside of a fishbowl.
Yeah.
Right? You know what's in the fishbowl, but you can't see into the fishbowl. Right?
Yes.
We're there in sitting outside looking in and maybe get a perspective of.
Yeah.
And, as part of any good portfolio, there's going to be diversification, right? And you can get very myopic in your view and looking at, whether you're in the Australian market or the US market or the Canadian market, that diversification is important. And, the Asian economy understands, right, that diversification is really important, and whether it be gold or commodities or equities or real estate or tech or geographic diversity that can bring it as well. There is no panacea from a location perspective.
Right.
Right.
You hit on something super important, which is when you are the fish inside the bowl, it's really hard to understand what's going on inside that fishbowl. And before we hit record, we were talking about just the cycles of empire and previous empires that we've seen come and go. And with absolute certainty, they all go eventually, always have, they always will. And I would make the assumption that the citizens within that empire were the last ones to see it coming. Right, but those watching the movie from the outside saw a lot of the indicators or took them more seriously, because reality is reality, right? This is where we live today. This is what will be tomorrow, right? Of course. So why would that change? It's been that way for a few generations. That's a good amount of evidence, right?
Yeah. Absolutely, and whether it be empires or whether it be businesses, it's exactly the same as well.
Yeah.
Right? When you fall in love with a product, right, and you can't see the product objectively.
Yeah.
You're going to have a problem.
Totally.
Right.
Yeah.
Again, we can repeat any of the stories, but look at who used to produce CDs and where are they at today?
Yeah.
Right. There's some really famous quotes
Yeah.
that came out of that space in terms of as technology would evolve. Well, that'll never get.
Right.
Yeah, it'll never get traction.
Yeah, 100%.
Right. So when people start believing their own rhetoric, that becomes a problem, and that's one of the things I think that we try and do as an organisation, as a culture within it, is to continue to challenge what we do.
Yes.
Is to create that environment where, we get an eclectic group of people together and we provide the environment that allows for that diversity of opinion to be able to challenge what we're doing.
Yeah.
Right? And, Ryan will hate me for doing it because I don't have my cell phone on me, but I'll use a cell phone as an example, and I use it in a lot of discussions internal with the business. Pretend I'm holding up a cell phone.
Sure.
Right? I've asked you, what are you looking at? And you're going to describe what you see. Oh, it's a cell phone.
Yes.
If I ask Ryan, he's going to say it's a cell phone.
Yes.
But his view on that cell phone, if we say it's analogous for a problem, is very different than what yours is, Jay, because of the perspective you see. So who's wrong?
Right. Well, we're closest to our own sensitivities.
Yeah,
right?
but one of you've got to be wrong.
Yeah.
Well, how many discussions start that way?
100%.
So maintaining that objectivity on the problem is key. And whether that be inside a business and tackling a technical issue or a socio-political issue, or whether it be dealing with, what's going to happen in the world is going to be key. And it's exactly the same as you look at, Ray's literature and the change of dynasties, or it's exactly the same. The people most impacted by it are the last people to see it coming. It's the boiled frog syndrome.
Yes, exactly.
Right, exactly the same. Right,
Yeah.
You've tried it with your boys, I'm sure. Right.
Oh, yeah.
You put the frog inside of a pot in cool water. Turn on the pot.
Yeah.
What does the frog do?
Yeah.
It stays inside the
out.
pot.
Yeah.
Right, until the environment
Of course,
kills it.
you get pushed a little bit,
And you try to adapt to the environment, and the environment will kill you. So you've got to maintain that objective view to look at what's happening, how do you adjust?
Yes. Okay. There's like a million rabbit holes I want to go down here. I love this stuff, quite frankly. But I want to drive into Calibre right now, because you are going through your own material change right now in-house. It's large. I think prior to the Marathon acquisition, you were producing somewhere around 280,000 ounces per year. When the Valentine mine comes online, that number gets closer to 500. It's very material. So for anybody who has heard nothing about this before this interview, maybe walk them through what's occurred. What was this acquisition in Canada, Ryan?
Sure. Yeah, I mean, as we sort of briefly touched on at the beginning of the interview, it was what we had been looking for was to grow the production profile accretively by looking at opportunities that we're producing that maybe we can unlock some additional value. And we had gone through some different paths and didn't quite get there. And we had been looking at, well, if we can't do that accretively to have share price performance, what else could we do? And that was then looking at a tier down and saying, okay, something that could be in production in the next, say, 12 to 18 months.
And was that the qualifier? It had to be near term. Like,
that was an aspect of it.
Okay.
Right. It was an aspect of it because obviously you have to have a good product, and then you have to be able to do it for the right valuation.
Yeah.
Right? So that was one of the criteria that we were looking at was, can it be in production in the next 18 months? Check. Yes, it can. And that's where we spent a bit of time looking at who are those players. So you keep drilling down, and then as you do that, we're doing a bit of our own due diligence to say, like, okay, if we did this or if we did this, would that pass the technical tests? Due diligence technical tests, just from a desktop perspective. And then you get to a point in time where you see, okay, look, that looks really attractive because 5 million ounces in Canada is a bit of a unicorn. Mm-hmm. Very difficult to find a proven 5 million ounces in a very solid jurisdiction that's advanced through permitting, that's advanced through economic studies, and yet still has a lot of potential and upside. So, and what really hit the nail on the head for us was the fact that you could see, as we started to track it, you could see there was a need for capital. And fortunately, Calibre was in a great position that we had no debt, and we were able to generate good operating cash flow and then free cash flow, even though we were investing in our own product, through exploration and mine development. And yet we had a great balance sheet we to be able to do that, to be able to transact on that during that time. And I think that's what was the selling feature, one of the selling features to the Marathon folks, was that, hey, with this group, they have production, they have operating expertise, but they also have cash that can get us through the build. Because remember, they were about 50% through construction.
Yeah.
And so we caught them at
right.
it was a transaction at a time where they either could have gone out and raised a whole bunch of money and diluted the shares more.
Yes.
They could have impaired the asset further.
Yes.
But we quickly went ahead and said, hey, let's do this.
We've seen both of those scenarios unfold, recently.
Right. Yeah. So I think we just caught it at an opportune time because, as Darren mentioned, their stock was trading at a 5-year low. They had been up to a $600, $700, $800 million market cap. They had been a very good explorer, finding more ounces.
Right.
And Pierre Lassonde was a big shareholder of the company, but they made a switch back in 2022 to go from an explorer developer to, no, we think the next value creation curve would be as a junior company with no cash flow to build it. And right. I think that was a switch for quite a few people. We've seen this story before, and it can be very challenging. People can do it, for
right.
sure.
Right.
But it's very difficult to get through all of the hurdles to get to that finish line.
How much of that was tied to the price of money, do you think? The assumptions they might have been making around that build. Money was very cheap still in 2022. It's not anymore. And that changes the whole paradigm.
Yeah, I think that it may have factored into it a little.
Okay.
But I think really the issue is that it's not about the premium on the debt. It's how much debt do you require in order to build. So I think the value proposition with Marathon started when they made the decision to build because they didn't have an adequate level of engineering to determine what the cost to complete was going to be.
Okay.
So, the decision itself, you can argue about the Lassonde curve and where it fits and where the value proposition is, but park that and just say, if you're going to build something, you need to understand what it's going to cost before you build it.
Yes. Okay.
Right? If you don't, then you're straight away down a spiral, unless you've got an unlimited source of funds available to you from a benevolent uncle who's
right.
going to fund you regardless of.
Yeah.
Well, they weren't in that situation. So they got into the situation where you end up destroying some shareholder value as a consequence of, with the ultimate goal of developing it, but you've got to go through that pain box.
Yes.
Right? So, again, where we stepped in is kind of probably at the peak of the pain for them because we're in a situation where they needed additional funds and we could come in and satisfy that need.
And I think you've got this figured out, but I'd love to hear it from you. How are you going to avoid a similar pitfall. We've seen a few stories really stumble at the finish line. Almost great companies, right? Walk me through your insurance against that. How does Valentine not become the next almost great story?
Yeah, no, it's a really good question, and that's where the focus of our DD when we looked at the acquisition is that we looked at it and said, okay, we know what it looks like. Now let's do some stress testing about what if it was $150 million more than what was publicised.
Okay.
Right, in terms of the build. What if there was 10% less grade? What if there was 10% more operating costs? If under those assumptions, will it still be a compelling value opportunity? Yes, it would.
Okay.
So we continue with the DD and continue with striking a deal. So we got to the closure. Now the real issue is, to answer your question, how do we avoid creating an issue? Well, when we purchased the asset, it was arguably at a 60% level of engineering.
Okay.
Right.
You said 98% today.
It's 98.
Okay.
Yeah.
Right.
So if we look at where it's at, to be able to estimate costs, you need to know what it is, what's the scope of the work. At 98% engineering, we understand what the scope is so we can estimate costs.
Right. Right.
From a risk perspective, a lot of the projects that have struggled because of below ground issues. I'll call them geotechnical.
Okay.
So it might be with respect to establishment of a tailings management facility or establishing solid base to be able to build a mill, right? That work had already been completed by the end of 2023. So when we purchased the assets, those significant risks that create hundreds of millions of dollars of potential exposure were behind.
Right.
So the geotechnical risks are behind us. We've got an adequate level of engineering, a high level of engineering to be able to determine costs. We've got a skill set where we've done this before, right? It may not have been within the Calibre brand, even though we have built a number of mines over the last few years in Nicaragua, right? The pedigree that I bring and others within the organisation, I spent, before joining this group of family of companies in 2015, I spent 30 years plus around the world building, optimising and operating assets for Newmont, right? That was my background.
Yeah.
So we're leveraging off that and the knowledge base that I bring and the contacts to be able to come in and put in place people that can ensure a safe delivery. Additionally, we've also employed an operations team since taking control of the asset. So we talk about those people are going to run the asset once it's built, they're in place. So that leadership team is in place.
Got it.
Right.
Got it.
Before purchasing the asset.
And that was a key part of it. That was a really critical part, and I think it's worth mentioning, is that wasn't that one of our big uncertainties was like, can you attract the right people?
Sure.
The right people
Yeah.
to be able to operate this properly. And that was a concern to begin with.
Yeah, absolutely. If you asked me, 5 months ago, what was the single largest concern? It wasn't the ability to estimate costs. It wasn't going to be the technical aspects of the project. It was going to be, can we source and retain the human capital
talent,
to be able to run it,
Yes.
right, and deliver into the expectations.
Right.
Now, 4 months on, we've put in place the team, and the majority of the team have relocated to central Newfoundland.
Okay.
They've taken families from
Yeah, they're
British
there.
Columbia or Ontario, they've moved to the island,
Yeah.
they've bought houses, they're growing roots, right? And this is in a market in the resource industry where it's like, well, we're competing for labour.
Yes.
So why is that? Well, I think it's the people are doing their due diligence on the company and the asset, and they're going, hey, we like the asset. We want to be associated with something good. We want to work with people that they want to pitch in with. And so they see that. So we provide a compelling value opportunity for those potential employees. So we've seen very good take up. So there's always a risk with respect to retention of people, but given we've got very good people who've come across, it means we de-risk the longer term because they're there. They're going to hire in. They're going to operate the asset the way that we want to see it operated, which is going to ensure that we don't see churn and turnover. So no, I think that coming back to your original question is that, why won't we have a problem? Is because the significant risk associated with geotech is behind us. Engineering is at 98%, so we can estimate costs.
Yeah.
We've funded it. We've put in place an operations team to be able to operate the asset a year ahead of commercial production. And another critical component is we've retained a group called Reliable Controls Corporation out of Salt Lake. And what their specific focus is pre-commissioning and commissioning. And most assets in companies our size don't employ groups like this. So what it is, it's to transition between the projects team and the build team and the operations team.
Interesting.
Right? So you're bridging that.
Okay.
Right? So it's a group of people to be able to transition between. Because the projects folks are all scope, schedule and budget. The operations team are all about optimization.
Yes.
Someone needs to bridge that.
100%. Yeah, I feel like I've seen that mistake made before, almost to a T, lacking that transition.
And that's
shall
where
remain nameless.
And when you come back in and you look at the team that we have at a corporate level within Calibre, and whether it be myself or Juan Becerra or Daniela Dimitrov, right? The capability we have within the organisation, because we've done this before in different entities, and some of them haven't worked out.
Sure.
Absolutely.
Sure.
So we've got those learned experiences we can bring in, and that scar tissue that allows us to say, well, this is what we need to do to ensure this is successful. This isn't our first rodeo.
Right? Okay.
So that's what, comfortable with the asset. So,
and most of those major concerning risks are in the review mirror at this point, most importantly, right? We've jumped over those hurdles.
Absolutely. There will be a work to do. There's a lot of wood to chop to deliver it. But it's relatively straightforward and simple. Right. De-risked is the way I'll use it.
And if things go to plan, we're on pace for commercial production, is it mid-2025 with this new asset?
It'd be solidly in Q2.
Solidly in Q2. Okay, got it.
Comfortable with.
Okay, I'm with you. Contributing around an additional 200,000 ounces per year to the portfolio at this point. We'll have to wait and see, but
On an annualized rate. Absolutely.
Okay.
Adding to our 275 to 300,000 ounce base with a 200,000 ounces gets us solidly in that 500,000 ounce a year producer rate.
Right. Okay. Right. I want to touch on the Nicaraguan assets. I think it's important to make sure anybody who's watching the story for the first time understands it's a big part of the operation. Nevada too. Nevada is important. It's a smaller part of the production, 50 to 60,000 ounces. But Nicaragua is a hub and spoke model. A lot of activity there. At a high level, would you walk us through? This was the first acquisition with B2. So what's going on in Nicaragua?
How far do we want to go back?
What I'd love to hear, here it is. I'd love to hear how Nicaragua and then Nevada and now Canada contribute to the greater vision of Calibre.
Oh,
right?
okay.
Yeah.
Okay. Well, maybe I'll start. Is that when we acquired the assets and partnered, as you rightly said, with B2 Gold, we had been there in Nicaragua as explorer, prospect, generator for the last 10 years. So we understood the jurisdiction. We had just come out of Kirkland Lake that had merged with our company, New Market Gold, and it was quite a significant success. And so the team, Doug Forrester, Blaine Johnson, Darren, myself, looking for what could be next from a let's buy production and see if we can optimize it, see how we could optimize it. And that's when we finally had this, Blaine had this final discussion with Clive in that, let's do this together, Clive.
Clive Johnson at B2.
At B2.
Yeah.
You divest of your Nicaraguan assets. We will take them over. We'll invest capital into them. We will do a bunch of things to unlock value. And how we do that together is you retain a significant equity portion. And you can also report that production, that percentage of production, onto your production profile going forward as B2 Gold. So it was a win-win situation as they were striving to be this million ounce a year gold producer.
Right.
So it was 2019. Gold at the time was, I think, $1,150, $1,200 an ounce.
Yeah.
And if we remember, pot was hot.
Yeah, that's right.
Cannabis was a big story.
Yeah.
And it was incredibly difficult to get any interest in resources or gold.
Yeah.
In the summer of 2019, we went out and we raised a little over 100 million Canadian. So B2 got a big portion of cash and then a portion of shares. And what we acquired was Limon, a smaller mill, and a larger resource base from the mine. Libertad, that had been in production for, a number of years, but under B2 for 10. And they had produced solidly 150,000 ounces out of that asset. But it was winding down because on the property, it had run out of reserves, essentially.
Okay.
So it was heading towards closure. And that was fully disclosed and known. And that's where Darren steps in and looks at this opportunity and goes, well, what can we do differently here? It's the analogy of the cell phone, looking at it from a different perspective, right?
Yes.
What could you do differently here that could unlock some value? Because what it was Limon was envisioned to be 50 to 70,000 ounces a year. Fine, we get production. But there was a bigger opportunity there, and that was Darren thinking through the steps of what could this look like if we mined at Limon, fill that mill, and then haul material to Libertad to keep it going, generating some operating cash flow, and then looking at little things around the edges that could provide for additional efficiencies to provide additional cash flow to then reinvest into that next maybe satellite.
Right.
And it was 2020 that we started to mine and haul material from Limon to Libertad.
Right. Huh.
So it was the starting point of, wow, look what this could be. Because we had another asset up in the north. We had the asset Pavon in the central region. So we had a number of different satellites or spokes that could feed into either one of these facilities. And so that's what you've seen, this natural progression. It's been a very slow, I shouldn't say very slow, but it's been a methodical, responsible approach to utilizing this operating strategy.
Okay.
Versus just turning it way up and, too many trucks, too much chaos, too much happening, and it would be probably too much for the market to go, oh my gosh, what's going on here? There's so much happening.
Right.
And you might actually see a production profile go like this and then like this. So just a nice, slow, responsible ramp up to bringing on these different satellites. And it's built credibility within the communities. It's built credibility within the government. It's built credibility with analysts and investors now because they've seen, hey, these guys can go from permit to plant in 18 months by following international codes of conduct, doing everything properly and transparently, and they've been effective at doing it. So that gave us a platform to grow from, right? That was the starting point. That was the unlocking of value, is looking at these things from a different perspective and then reinvesting into exploration and mine development.
Yeah, I think it's the identification of the opportunity that's the challenge. A lot of work goes into delivering into the opportunity, but it's identifying it.
Sure.
And as Ryan talked about, when we partner with B2 Gold, they're a great operator, a great builder of. We're doing a fantastic job and continue to do a great job, right, in all of their assets. But the opportunity that was missed in Nicaragua was there was two assets being operated as separate companies as opposed to looking at them more holistically. So you had a capital constrained asset at Limon where the mining capacity was larger than the mill. So it was mill bound.
Right. Okay.
200 kilometers away.
Yeah.
You had Libertad, which was a great asset that B2 Gold had built, was going to closure because it had no feed. Well, the solution's pretty obvious.
Right. You've got a second.
Just line balance.
Yeah.
So debottleneck Limon by hauling material to Libertad, right? Leveraging off that significant capital that had been invested a decade earlier.
Of course.
At Libertad, right? And so, it's all about what's going to create value and it'll generate production growth. But it's not production growth. It's about generating value. We purchase those assets for $100 million is what we purchase them in a combination of shares and stock from B2 Gold.
Okay.
The value pre-marathon was in the order of
$700-800 million.
$700-800 million.
It was our market cap pre-Valentine.
Right. And so it's identifying that opportunity and then committing into it. So it's like, that's the value. Now, the expertise that we bring in terms of delivering is key because you've got to be able to deliver into the dream. Right? It's the identification of the opportunity. And the Libertad mill was the key. Everyone looked at Libertad as the boat anchor and the shiny object was Limon.
Right.
But Limon was fully valued in it. It was the opportunity to be able to talk, how do we turn that $400 to $500 million of investment that B2 Gold did, which was valued at zero, into something. So utilising the sunk cost. Right. Which then allowed us to, and then generate cash, do the exploration, which has allowed us to produce, since acquiring the assets, 825,000 ounces, and we've grown net of that production to over 1 million ounces of reserved, and we've, for the last 3 years, been able to maintain that reserve base. So we've got a very prospective region, and we've taken the opportunity over the last 3 or 4 years to establish that base, generate cash, which allowed us to do this. Well, COVID and other things were happening as well. So it's that kind of, that thoughtful, consistent delivery into expectations. And one of the value opportunities we see from Marathon is obviously the diversification of production risk. And because as a single asset producer, which as Nicaragua was, and the perceived geopolitical risk associated with Nicaragua
Sure.
comes back into, well, diversifying that is great. Yeah, it is. But I think what people were starting to understand during 2023 is that the perception versus the reality of Nicaragua, right? For 20 quarters, we've delivered into guidance.
Right.
How many single asset producers anywhere in the world, whether it be Western Australia or Ontario or Timbuktu, have delivered into guidance? Well, what does that say? It establishes a credibility within the people managing the assets in Nicaragua, one. But secondly, it also establishes credibility of the jurisdiction.
Yeah, right. Of course.
Right.
Of course.
So you can. Oh, why? Well, because you've got the right people in the right place delivering into.
Yeah.
So we're starting to see that. And that's the value opportunity, right? Is the re-rate potential that comes from the Nicaraguan assets, right? Or Calibre 2.0, Nicaragua and Nevada, right? We're undervalued with respect to our peer group because of, then we add in an asset which was undervalued because it was a great asset, but there was a concern about the deliverability. You raised it before.
Yeah. Yeah.
Right? Now we can get the value derived from that because that asset is now in the hands of people who can deliver into it because of the demonstrated
The track
capability
record.
over the last 40 years
100%.
to do that. And then combined, you're moving up the tier scale from a junior to a mid-tier,
Yes.
right? So you've got those three re-rates that are going to come. Right?
Yeah.
So, no, I think we're well poised for that next inflection point. And we're also doing it at a time of an escalated gold price. And if people are complaining about the disconnect between the commodities and the equities,
Okay.
I'm not unhappy about that right now.
Tell me why.
Because never let a crisis go to waste, right? We used COVID in Nicaragua, right, to be able to establish an operating credibility and to get a significant land position and to be able to build a business, right, during COVID. Well, it's the same thing a little bit with the gold price and the equities, right? We've built cash and grown the business in what was a less buoyant gold price market.
Sure.
Now, we haven't seen the uptick in the commodities, in the equities,
Yep.
right?
Yep.
We have in the commodities.
Yeah.
We're now going to build into this production growth at the same time,
Yes.
right? So there's a little bit of a rubber band impact happening here. So people saying, well, we should see that. It'll come.
Right.
It'll come, right? Be patient, be persevering, and continue to do the right things, and you will be rewarded.
Yes.
Right? But you've got to play into a medium, longer term strategy. And you've got to get yourself into a situation where you're not trying to respond to which way the wind's blowing today.
Yeah.
Right?
So,
You be consistent in your approach. We know what we do. We're good at what we do. We can't control the macroeconomic environment.
Yeah.
But all the things are pointing to if not further, increases in gold price, at least a consistent gold price out for the medium term. Right? We're going to be delivering into that from a production perspective. So the opportunity from a cash flow
as
perspective
a
is
producer
huge.
of that asset.
So it's about being opportunistic,
That's a great perspective.
right?
It's like, for a public market company, sometimes the company can outperform the valuation. And sometimes the valuation outperforms the company. But over a long enough time period, those two things usually don't stray too far from one another, right? Time's the ultimate truth teller.
Yeah. And there's going to be sometimes you're lagging, sometimes you're leading.
Yeah, exactly.
And I think in our situation is that because of the things we talked about, the single asset, jurisdiction, right? Some of the erosion in value we've seen from the issuers as a consequence of not delivering into commitments.
Yeah.
There's been a reluctance to invest into. That's fine. We're taking a long-term view. We're shareholders in.
Yes.
We're in here for the long term. We're not looking at trying to turn a profit in three months.
Yeah, exactly.
Right?
Exactly.
So we will benefit from taking that approach as we birth Valentine and bring in this consolidated series of assets into a rising, very buoyant gold market space. So I think that those who participate will benefit significantly from an investment they make into Calibre. Right?
Yeah. And Ryan, please.
Just to add on to that, never let a crisis go to waste. It's like the Marathon transaction. Yes, there were some other things, but if the equities were trading at full value, to the gold price at the time, Marathon would have been a much different transaction for us.
Right, much more expensive.
Much more expensive. Yes, the business or the company put them in a different situation, and maybe it would have been different, maybe it wouldn't have been. But if the equities were trading closer to where they should be at the current gold price, I don't think that opportunity would have presented itself. And so,
For sure not in that way.
I mean, 5 million ounces, again, I keep coming into 5 million ounces in Canada. It's going to produce 200,000+ ounces a year per the feasibility study at $1,000 an ounce with another 1,000+ margin. Those are going to be very difficult assets to find. And, as Darren said, I agree. I think slowly but surely you're going to see higher and higher gold prices because of various macroeconomics. And you've talked about this on various programs of yours. You've had people, specialists on the show, but it just seems like we're in a situation here where there's a lot of physical demand for gold. Central banks buying all around the world. The gold price has been going up, and yet traditionally or historically, we're in an environment where you'd think it'd be more difficult for physical gold price going higher. And the reason would be is higher rates, stronger dollar.
Yeah.
Now we're kind of transitioning to a point in time where we could see easing of rates, a weaker dollar, which is probably more positive for gold. And so, and I think that there's probably an investor base out there, an institutional or retail investor base out there that in various cycles have been, have bought in, and then a cycle rolls over and they're left kind of going, oh my gosh, I just lost all this money because it's a very cyclical business.
Yeah.
Right? And so maybe people are a little slower to take the next step to buy into this type of, oh my gosh, we're in a very different environment and look at these equities, they're incredibly cheap versus what we've seen historically.
Yeah. I mean, the movie's played out a certain way a few times now, many times, right? Where we see the underlying metal appreciate, and then eventually it trickles down to the producers, and eventually maybe the upscale royalty companies and the developers, et cetera. Timing that movie's impossible for me anyways. But frankly, I don't care because that's not my job to time the market, right? It's my job to identify things that are undervalued and buy those things and then wait. I actually get a bit of anxiety when the gold equities start to run because I just feel like, did I do enough? Am I positioned where I should be? I don't have a positive response. You think I might, but I don't. I have anxiety. That's my response that I get. So you mentioned, I think you said $1,000 ASIC on Valentine. Did I hear that?
Per the 2022 feasibility study. I think, but again, we're probably, in context to actually delivering into that, I would say it's probably optimistic that would be the case.
Okay.
However,
All right.
As Darren will tell us, we are finding things within the study versus the contracts we've negotiated that are savings to some of the things that were in the study. So will it be a balancing act?
Yeah, sure.
Probably. Will we get, close to 1,000? Probably within the range.
All right.
But we're always the type of group that doesn't like to disappoint. So we're always going to under promise, I should say, and over deliver.
Yeah, and what's important here is that, arguably the most marketable commodity we have is our reputation.
I love that.
Right, and so, we don't have a stakeholder that we want to disappoint because there's absolutely no advantage to us because we're not here for a minute, we're here for a long time.
Yeah.
Right, so, as we've demonstrated, we're going to continue to deliver into. So even by Ryan's comments, when we're talking about our comparison with respect to the feasibility study, right? Feasibility studies, by definition, are optimistic.
Okay.
Right?
Yeah.
It's a sales document.
Yeah.
Right. It's a sales document even internally.
Yeah.
Sure.
Because if you torture the asset long enough, it'll confess the result that you want.
Okay.
Right?
Yeah.
Again, because you'll look at it, you'll study it, you'll turn it on its head. You're not looking to add conservatism. You're looking to get to a point where yes, it's attractive enough.
Yeah.
Right, and you've got to deliver into it.
Yeah.
So will we see there's going to be some tension? Absolutely. There's going to be tension in some components of it. But we put the right people in place and the right operating team in place, and they'll be able to deliver into those expectations and realise the full potential of the asset. And we'll do it, even from, Ryan alluded to it, But we've negotiated long-term frame contracts for cyanide and grinding media that are much more favourable than what was included in the feasibility study. Why? Is because we have scale, which is different than what Marathon had when they were pricing it. And we have credibility in the market because of the relationships that we have and the tenure that we've built with those vendors over the last 30, 40 years.
Right.
So, they're going to be positives. People are always going to cost more, right? There's not a person that's come. How many of your employees come to you and say, hey, Jay, look, here's some money back, pay me less tomorrow? It doesn't happen, right? As humans, we have an insatiable desire and appetite for, right? So that'll continue. There's always going to be capital, there's always going to be tension on the human capital portion of it. Right? So you look for other offsets, but really what you want to do is say, the human capital piece is a fixed cost. How do you get most value out of the fixed cost? And that's ensuring that you're providing the environment that allows for you to attract the attractive talent you can into the space. So no, Valentine will deliver into expectations. But the reason we say, well, call it $1,200 rather than $1,000 an ounce, is because if you're making the decision as to whether it's 1,000 or 1,200, then you're probably trying to get it. You're probably trying to put a level of precision.
Like if it has to be one or the other for the project to make sense.
Or if you want to make a decision based on whether it's 1,000 or $1,200 an ounce, walk away.
Good call.
Walk away. It's not within the error of the estimate. So if you can't live with that level of risk, don't do it.
100%.
Don't, again, you've got, so again, that's why we'll take the approach where we'll create an expectation that arguably may be a little conservative. But at the end of the day, people will then make the decisions on that. And when we come in and deliver into it, or do better than that, they're going to feel good about it. Right? If we come in and say it's X and it's 5% more than X, but it was still accretive for them, they're going to be disappointed by that 5%. Right? That psychology is really important too. Like come back to our single largest marketable product is our credibility. Right? And we will realize the full potential of any asset we own. Right, whether it be Nicaragua, Nevada, or Newfoundland.
I think Nicaragua has great evidence of that, right? Really taking a deep look at how else can this be leveraged more effectively, and do we have the tools to do that? You mentioned you've maintained the resource 3 years going, so as you deplete, you're replenishing the resource. 5 million ounces in Valentine, and indexes are noticing, right? Calibre is now included in the GDXJ and the TSX composite. Maybe with the TSX composite, just touch on the significance of that. What does that mean for a shareholder of Calibre, a prospective shareholder of Calibre, to see this company now included in these indexes?
Well, it's basically the world we live in now. I mean, as you're delivering, and this is it kind of speaks to a little bit, in my view, active versus passive investment. So you've got, I think historically, before ETFs, it was all active management, right? You had a portfolio manager picking stocks, all over the place, and trying to beat some sort of, let's say, TSX average, right? Now you've got the introduction of ETFs that are basically the same thing, but kind of a mandate that says, okay, let's take the GDX. It's only going to invest in certain things with certain market caps, certain liquidity, et cetera. So, and then it just clumps them together, and then various folks that were portfolio managers or active managers will just buy that ETF. Because it gives them exposure to what they want to do and what sector they want to have exposure to on a quote unquote, maybe less risk basis. But, so the significance of it is that it's very likely, as long as we're in this cycle, or a cycle where we maintain a certain, within the mandate requirements of that ETF, it's long-term capital and low turnover. So that's very attractive for a public company. That for example, in March, the GDX became one of our larger shareholders. They bought over 55 million shares on one trade. So that's now plugged away, that's locked away, as long as we stay in the band of that mandate. We were in the GDX already, so we had gotten bigger. So we were in the GDXJ previously, as a junior producer. We then got into the GDX. So they're almost a 9.5% shareholder of the business. And as long as you stay in those mandates of their requirements, that's long-term capital plugged away. So there's positives in that, you probably won't see a huge amount of that coming back into the market, whereas a hedge fund or other investors, they're trading more often to try to beat those indexes now, right?
Yeah.
So the more you have in those passive funds, in my view, the better for the shareholders, because I think that can create share price performance torque, because you've got more shares that will not trade, less float that will trade. So it does become a significance for people watch that and they trade to those, inclusions.
Yeah, of course they do. Of course they do.
And
yeah.
I'd agree with what Ryan said. I'd add one more piece to that, though, Jay. You asked the question, is what's the significance, right, of it? And one of the things that I take, and maybe it's personally, is that I see it as a vote of confidence in the product.
Agreed.
Because at the end of the day, whether we talk about active or passive, there's a mandate from the establishment of that fund to generate a return for the owners of the fund.
Yeah.
And in doing that, it sets up what it believes, as the fund managers believe, someone setting up the criteria for selection of the entities or the equities it's going to buy within that fund to generate a shareholder return. They've voted us into that as an acceptable product, an attractive product.
Yeah.
So it's confirmation of. So even though it may be arguably passive, there's an active piece in terms of setting up what's in and what's out. We've been voted onto the island.
Yeah.
Right? So it's affirmation for, right? So it's maybe a little perverse way to look at it.
Totally.
But I look at it and I go, I think it's significant because as you get included in those, it's a vote of confidence in.
Yes. And, a very important
what are we
data point
looking
for
for?
investors to see?
All investors, retail,
everyone,
institutions.
Coming back to back to the credibility.
Yeah.
What's the single largest concern that people have with their investment?
It's going to go down.
Right. So the more people you can have that are pointing to you as a safer investment within that basket of options is going to be attractive.
Always.
Right?
Always.
So when we see assets like ours, which, we can sit here and say that we're undervalued, but when we have people who we've hit the hurdles to inclusion in those and we're undervalued, there's got to be great opportunity. That's why the funds are coming to us. That's why it should be a good reinforcement for people who are looking to make those investment decisions. What do you want to do? You're looking at making a decision. You're going to triangulate your opinions.
100%.
So it's another source of data to go, I'm de-risking my investment because of.
Agreed.
So it's a good thing.
Agreed.
It's a good thing. I know some people will actually point to them and demonize them to a degree. But I'm looking at it and going, it's what it is.
I get that. There's a lot of capital moving from, call it active to passive but you can demonize or it doesn't matter. It's what's happening.
Sure.
So feel how you want to feel about it. That's where money's going. And that's what matters. Yep. So pay attention to reality. It's okay to have an opinion about it, but also play the game as the cards are being played.
Correct.
Right?
Why is the money going there? Because the investors see it as an opportunity. And the fund managers are getting rewarded based on the return on that fund.
Yeah.
Being included in that fund is a vote of confidence.
And it's a high risk business, this business that we're in. And so if the everyday retail investor needs a data point like that to feel better about where they're putting their cash, that's important, right? It's very important. Okay, now, obviously all eyes are on Valentine right now, right? Of course. But you're long-term guys. And so what's the bigger picture for Calibre into the future? Are we looking to increase the ounce count? We're graduating from junior to mid-tier producer. What's next in the periphery down the line?
Credibility is important. So what do we need to do? We need to continue delivering in Nicaragua.
Yes.
We need to deliver Valentine, right? Anything that gets in the way of that is value destructive for our long-term shareholders.
Okay.
So that being said, park that. What does the future look like? Well, in Nicaragua, it's been great for us and it continues to be, but we've still got 1 million tons of surplus capacity in Nicaragua.
In Libertad.
At Libertad, at the mill.
Yeah.
So putting it in perspective, Limon is a 60, 70,000 ounce a year producer and it's a 500,000 ton a year mill.
Right.
So the latent capacity at Libertad is arguably 140, 150,000 ounces a year.
Okay.
So you think about the torque to metal production, obviously it's huge. Importantly, the torque to free cash flow is significant because the fixed costs that go into running that plant are already there. So the incremental costs are going to be quite low. So the value opportunity that can sit there is huge. We haven't talked about Nevada.
Not yet.
Right? And what is Nevada? Well, it's a cash flowing exploration asset, right? It's a 2-to-1 strip ratio, 0.4 gram per ton heap leach operation in Nevada that pays its way. Right? Modest increases in grades will have a significant impact on metal production as a portion of, right? If at a 0.4 gram per ton head grade, if we get it to 0.6, which is de minimis, it's a 50% increase in metal production. If we improve the grade from 0.4 to 0.6,
yes,
are we going to see a significant increase in cost? No. Very few of our costs are related to the grade of the ore we put on a pad or put through a mill. Right, so the torque is significant. So the exploration and the continued focus on exploration in Nevada is huge. There's a lot of gold in the district. It's a very prospective part of the world.
Yeah.
We've demonstrated that even modestly in the last 2 years since we've had the asset. Net of production, depletion, we've increased our reserves 50% in Nevada.
Right. Okay.
Right, so it's there. Right, takes time to find. But we will eventually tag into something that's going to be significant in Nevada.
Okay.
Right, all of that gold came from somewhere. So we'll continue to look for it.
Yeah.
Right? So we've got Nevada, the reserve or the exploration potential that exists,
Yes.
the torque from production growth by utilising the installed capacity, aka capital that already exists at Libertad.
Yep.
And then we talk about Valentine. You know, one thing we haven't touched on with Valentine, great asset, good, simple operation, all of those sorts of things, but it's a greenfield site. Right? This jurisdiction as an operation, it's not an operation yet, but it will be here very soon. As an exploration player, it's 10, 15 years old.
Right.
It's brand new.
Yeah.
Right? There is no pre-existing operations within 100 kilometres of what we're doing.
Yep.
It's not a brownfields rebirth.
Yeah. Yeah.
It's a greenfields.
It's quite novel these days.
It is, and that's where Ryan talked to the 5 million ounces that's there as a unicorn. But I think the real unicorn here is 5 million ounces on a significantly underexplored land position in a very favourable jurisdiction in a tier 1 country.
Yeah.
Right? What a great place to be. And we can talk about the geologic expanse there, but we've got a very prospective 32 kilometre shear zone, the Valentine Lake shear zone.
Yeah.
There's only been activity really on 6 kilometres of that shear zone. And, if we go through the history, what the feasibility was based on was a 3-pit plan. That plan, there's 3 pits. There's Leprechaun, which was discovered in 2012. There was Marathon, which comes subsequent. The permitting process actually commenced on those 2 pits. While the permitting process was in play, Berry was discovered in 2019, 2020, which is in between the two.
Yeah.
Right? So even we got 2 pits and stumbled across 1 million ounces between those 2 pits while we're in play.
Yeah.
So, the prospectivity of this is huge. So we start talking about what central Newfoundland's going to look like.
Yeah.
I mean, when your kids are talking about this in 40 years' time, and they look back on the tape that Dad made back in the day, right? It's going to be, that's pretty exciting because this is going to look like, a Timmins or a Kirkland Lake, right? Those sort of, it has the real potential to deliver into that magnitude of. And that's why, Ryan had mentioned earlier, Pierre Lassonde was significantly invested into Marathon Gold. And why was he? Not to develop a gold mine, but for the exploration potential that existed that then could lead to. Why did he become not a shareholder of Marathon Gold? Is because they made a commitment to build before he believed they fully understood what the jurisdiction looked like.
Sure.
Right?
Sure.
So, all of those anecdotal things lead us to a very exciting piece. So,
well, it's important to understand that scale, the 36 kilometre shear zone, of which 6 kilometres, 20% has seen activity thus far, right? We're scratching the surface here.
So we talk about the value opportunity, right? It's the 1 million tons of capacity in Nicaragua. It's a significant exploration potential
In Nevada.
in Nevada.
Yeah.
And it's the embryonic nature
Right.
of Valentine Gold Mine and that jurisdiction in terms of where it sits in its maturity curve. It's a baby. It's not even a child in terms of where it sits.
Yeah.
So you look at that and you go, there's huge potential for us from an organic perspective. As we start to get recognised for that value, right, that'll create lots of shareholder value. But importantly, it'll also position us well if there's other opportunities that come up as well. So you asked the question, the leading question here was what happens next?
Yeah.
Well, we're absolutely focused on delivering the value that we can exploit from our existing assets and realising the full value. But we will also always be opportunistic if the opportunity presents and it doesn't get in the way of realising the value from our existing assets.
Yep.
Right, it's being opportunistic. And that's part of, putting in place teams in the jurisdictions that can run and manage the assets. Right? They're a profit and loss centre. That's what they're accountable for. We delegate the authority so they can deliver into those accountabilities, right? And we provide a level of corporate governance and oversight. And we do that. We maintain a pretty agile base and a relatively low cost. I mean, comparatively speaking, I think our G&A costs are probably 1/3 of our peers, where it's typically around $50 an ounce. I think it's typically in the probably 120 to 150 is our peer group. And so even though we've got this rapid growth, we're putting in place those teams. So we don't have central control, right? Because we don't want the centre to get distracted by something that doesn't realise the full potential of the assets, right? People at the assets need to be absolutely focused on, right? And ensuring that they have ownership in and the authority to make the decisions to realise that full potential. So no, great opportunity from our organic set, and we'll maintain the opportunity to when things present.
When something looks right,
but it'll all come off delivering into expectations, maintaining a solid balance sheet, and maintaining a healthy treasury position.
Yes,
right?
Yes, the most important resource.
That was the opportunity. When you see lots of discussion about costs and all-in sustaining costs, but at the end of the day, do you have more money in the bank now than what you did before? And you go back through the history, right? At the end of 2019, when we concluded the deal with B2 Gold, net of obligations to B2 Gold, we had $4 million in cash.
Okay.
Right? Prior to the private placement into Marathon in Q4 of 2023, if we hadn't done that, we would have had $115 million in cash. Right? So building mines, building production, investing back in the assets, spending $100 an ounce on exploration, we still managed to build $115 million worth of treasury.
All through operating cash flow, right? It's not issuing shares to raise capital, but that's all through optimization of those assets.
Right? Yeah, so very important.
So again, maintaining that liquidity and that strength is key, because it's what provides the optionality, right? So you don't have to over leverage yourself, because at the end of the day, you've talked about the cyclical nature of. We always want to position ourselves to realise the opportunity that can come from an escalating gold price. But we want to ensure that we can live through the cycles, because when we live through the cycles, there will be people who overextend themselves that'll provide us an opportunity.
Always.
Like, look at our last acquisition. It was exactly that.
Yeah, 100%.
Not necessarily commodity driven, but if you maintain the optionality and the agility, you'll be able to seize the opportunities when they present.
I love
and
that.
That's what it's about. It's about taking that longer term approach. So what I'm very careful about is just ensuring to people that whatever opportunities we look at will not get in the way of our ability to deliver on our existing commitments and realise the full potential of the existing assets.
Yep.
Right? Because as soon as we start to talk about other things, people go, oh, hold on, you're going to spread yourself too thin.
Right, of course.
It's like, no, we're not going to do it at the expense of, because there's so much value from our organic opportunities.
And being thorough with what you have, right? Yeah.
But you want to maintain both.
Of course.
So how do you have your cake and eat it too?
Oh, yeah.
Put in place the teams of people who can realise the full value.
Okay. Look, this has been great, by the way. It's been really good to just sit down with both of you and get an in-depth look into the operation and how you think about this, how you make these decisions. And I really appreciate this. It's been fun and enlightening. So thank you for coming in and chatting with me today. I'd love to do it again when we're down the road towards first pour, at Valentine, and just get caught up both on that operation and what else might be in the periphery at that moment. But Ryan, Darren, thank you both very much for coming in today. I appreciate it.
Thanks, Jay. Appreciate the time. As always, a pleasure.